And when you look at comparable volatility indicators in the bond market to the VIX, and I've got my eye on the MOVE index, is that underpricing the risks that we've been talking about, or is it really capturing the zeitgeist at the moment?
No, I think we think that vol in bond rate vol, at least spread vol is a little bit different, but rate vol is still at fairly elevated levels. You know, we've kind of recalibrated to an entirely new regime from what we had seen kind of pre-COVID and certainly pre-inflationary shock of 2022. And so rate vol is still fairly high, and we think indicates sort of this kind of uncertain environment where bond prices are moving around with a fair degree of velocity and significance. The question is it going to go meaningfully higher? We don't think it will, and in fact, we think over time rate vol should start to come down, and it was showing some signs of coming down earlier this year. And all that means is that, again, as I mentioned before, the market is becoming more conditioned, better conditioned to sort of the macro backdrop, and there are less structural supports in the system from the central bank. So our expectation is rate vol stays high. That means, you know, we will see bond prices move up and down. But when we pivot, say, to the credit markets, where we look at credit spread vol certainly picked up a little bit over the last few weeks, but still remains fairly low. If you look at traditional investment grade credit spreads at around 100 and high yield at around 340, those are both for US dollar credit spreads. They're telling you that the market is in pretty good shape. We're not really expecting any meaningful slowdown. Cash flows are still pretty good. Credit conditions are still pretty healthy. So, you know, that rate vol is still isolated to interest rates and is not trickling through to, say, balance sheet stability for, you know, major borrowers in the economy.
George, from geopolitical risk to political risk as we hurtle towards the US election in November, if indeed Trump gets back in, what are the implications for debt and deficits, and how might that affect the bond market?
I think the simple message is deficits probably get bigger, and the debt load grows along with it. You know, our view, the all-spring view, really for bond investors has been pretty straightforward. It's pretty simple. Number one, you want to diversify your duration. There's some big macro variables that are out there, and so the cone of uncertainty is very wide. And so you want to have diversification in your duration. Number two, you really need to preserve the flexibility in your portfolio. This is not a market where you can just set it and forget it. Bond investors need to be nimble. We need to be able to pivot both from a duration perspective and from a credit perspective. And then lastly, it's really, really important to be very specific and very intentional with your risks. Risks in the bond market can get easily overlapped. There tends to be high degrees of correlation between different factors. We talked about political, geopolitical, economic, interest rate. Sometimes these can overlap. We need to make sure that those portfolios, the portfolios are very clearly segmented so that you have those risks isolated. It sounds very general, right, but these are very specific exercises to sort of manage these kind of big macro risks. They're not going away. They're going to be with us for the foreseeable future. And a bond investor needs to be nimble to be able to take advantage of the dislocations that occur when the surprises kind of